So it's 7:03. I'm gonna go ahead and get started. Tenny, Mike, can you guys just man the the I think some people are still joining, so if anybody joins in, you can just let them in. So
Got
welcome
it.
everybody. This is our first investor call, quarterly call for 101 Ellwood. This is just to review the performance of 101 Ellwood and to give you guys the opportunity to ask any questions, get clarity on what the asset is doing, what your investment is doing on the asset. So and just as a recap, we acquired 101 Ellwood on December 31st, 2022. And the main goal was this asset was like a stabilization play. We came in contact with this opportunity through one of the banking relationships that Dr. Oni has, finding out that it was an asset that is right in the stock middle of the two Johns Hopkins hospitals, and it was being poorly managed by a group that owned this property out of Florida. So that's the opportunity we saw in this asset. Took it over December 2022. And needless to say, the ride hasn't been a smooth one with this asset. If you've been joining the previous calls, you know when we got in, experienced like a big, huge delinquency from a bunch of unqualified tenants. At one point, we had almost 40 people on the delinquency list. So we got to work, working extremely hard, getting rid of those troubled tenants to get the asset fully stabilized. At the peak of the of the challenges that we're having. At one point, we had this asset down to about 72% occupancy, where we had to get everybody out of there and start replacing the tenants with more quality tenants. So that was our vision going in, but the situation we met when we took over the asset was actually more severe than we thought, and the stabilization process took way longer than what we actually anticipated. So the goal, really, this asset is really positioned in the Baltimore market. Is one of the unique areas in the Baltimore market, if you live in this area, that you want to own a real estate property in, because it sits right in the middle of the two Johns Hopkins hospitals. It's 6 minutes drive away from Johns Hopkins Bayview, and about 13 minutes drive away from John Hopkins main campus. So our goal was to get rid of those people and then start replacing those tenants with higher quality tenants with a lot of healthcare workers. And I'm very happy to report that that we have executed that plan successfully. We can say that like 101 Elwood is now a stabilized asset, and we're just moving now to the next phase of the business plan. So as you can see here, this shows like the occupancy versus pre-lease trend on 101 Elwood. And you can see the occupancy has been averaging at about 90%, with a pre-lease right around 92% at every single time. And this is a huge, 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 significant difference from where we were for a very, very long period of time, with the occupancy being down in the 70s and 80s, and us still struggling with a lot of delinquency. So right now, 101 Elwood, we're getting a lot of. When I switch over from this presentation, I'm going to switch over to like our real life our platform that we use to track leads. That is going to show you guys like the actual occupancy or the projected occupancy, so you see how great the asset is performing. So the asset is doing really well. The marketing is top. We're getting like really good tenants now on the property. A lot of Hopkins physicians and nurses are now tenants in this property. So the asset is stable, and we're just capitalizing on what's happening in the market, giving it time. The biggest challenge with this asset is like the loan that we acquired. This asset was the loan that we assumed. That loan expires this year. So the goal was to get this asset stabilized and possibly exit this year if the market is stable. But where we sit right now in the commercial real estate market is not an ideal time to exit. So right now we just get maintaining the stabilization phase and getting the asset just ready to extend the loan a little bit and give the market time to stabilize. You can see the income trend on this property. Actual rental income has been trending around $230,000, which is great. The gross potential rent, that's the rent in the market, has been pretty much stable. The Baltimore market has been really experienced some significant challenges over the last 2 years. But right now, a lot of the deliveries that came to market in Baltimore have already been absorbed, and there are no new constructions that are happening in this market for the next few years. Very limited number of supply coming in. Now, if you look at the data for markets in the US, Baltimore is actually one of the very few markets that is projected to have some kind of rent growth this year, and that's because of we've gone past that worst moment where Baltimore tanked to like a bottom, and then now the new units have been absorbed, and now we're starting to see some rent growth in the market, and 101 Ellwood is going to capitalize on this as well, especially now that our occupancy is in the 90s and we projected to be in like 95% occupancy in the next month or so. So again, on the expense side, our expenses have stayed pretty much stable around the 130s. We're working extremely hard to bring this down. The next time we do this presentation, you're going to see that the expenses have come down significantly. One of the biggest expenses that we were incurring in this asset is the marketing, especially when we went into that period of low occupancy, trying to market to the Hopkins crowd, to the medical community to bring in more people. We use a bunch of different marketing sources, from the Zillows to the apartments.com. But along the way, we onboarded a very, very, very unique system that is very, very efficient, and that gives the results. And that system actually adjusts to where the market is, and is very, very targeted. So we are letting go of a lot of the marketing expenses that we've been having, about $10,000 a month that we're spending in additional marketing. That contract expires, I think it's like next month that it expires. So now we're focusing just on one marketing source that is very dynamic and very effective, bringing in the leads and targeting the kind of tenants that we want. So we've been able to save a lot of cost over there. We're working on multiple other cost saving measures as well, and trying to build other income sources on this property. We've looked at getting cell phone towers on the property to generate income from that. So we're still doing some research on that. We've looked at solar. Unfortunately, that is not a good fit at the moment. And we also have conversations about bringing in one of those nice fancy vending machines, or the vending studios, into the property. That way, we could generate extra income for the property as well. So our goal right now, where the asset is like stable on the rental side, is continue to grow the rent on this property, decrease the expenses, like bring the expenses down 10 to 15%, and then work on like other revenue sources. The garage right now is about 77% occupied. Our goal really is to get that number to like 92, 93% occupied. That is a significant source of income. But our focus going in was, first of all, stabilize this asset, which took us longer than what we anticipated. Now that we have it stabilized, we're getting good quality tenants over there. We're going to start building those other income sources as well to continue to increase the revenue on the asset. And one other great thing that happened recently, we were able to contest the taxes on this asset, and our tax basis for the year got decreased by about $101,000. So our tax bill is coming down significantly. So the expense line item that you see over here is going to drop too as well, because we're going to be saving about $100,000 in taxes. So, and this is where you see the NOI. Again, like I mentioned, my goal is that the next time we get on this call next quarter, you see this NOI is looking much higher. It's on the uptrend because we're saving on expenses, we're increasing the income, increasing the occupancy on the property as well. So, but just from the data that you see from July to now, we've had over a 10%, about a 10% increase in the NOI. So the property right now is stable and is heading in the right direction. Our goal with this property is to execute a smooth, successful refinance, and that is going to happen in the next 3 or 4 months. As soon as we do that, we're going to resume distributions on the property. So right now, the only reason why we're pausing distributions is so we should execute that refinance. Every other resource that we have, we're holding it in reserves until we execute that refinance. And just of note, This is actually something that we did earlier on when we got in and realized that this property was not doing well. We actually left in like the acquisition fees that were due to Excite Capital, the main manager on this deal. We left it in this deal as reserves because we wanted to make sure that we have enough reserves to stabilize the asset. And thankfully, we haven't used all of our reserves, and the asset is heading in the right direction. So once we execute our refinance, we're already in the process right now, going through all the inspections and everything. Once we execute our refinance, and then we're gonna be able to start to resume distributions. And again, a missed distribution is not a lost distribution. The way these assets, these investments are structured, you get priority over the cash flow. So as soon as if we're able to execute like a cash out refi, which would depend on where the interest rates are when we go to refinance. If we're able to execute a cash out refi, then the cash out will be used to pay back all the missed distributions. The structure of the deal will remain the same. Then we'll continue to pay distributions until we exit. I uh I anticipate we probably gonna exit out of this asset in like about three to 4 years. Give the Baltimore market some time to fully stabilize. So once we execute our refinance, we start redistributing distributions on a quarterly basis. Give the market some time to restabilize. With everything that's happening in the DC market flowing into Baltimore, um, I don't want to be too optimistic about the Baltimore market, but there's some signs that things are probably going to pick up in this area. So we'll capitalize on that and position ourselves well enough to exit. Um, Delinquency it's been a huge issue for most properties in the entire USA. Baltimore was no stranger to that. On average, we've done really well the last few months with delinquency. This last month, we've seen a slight uptick. A couple of these delinquent tenants actually have a pre-approval for rental assistant program. So I anticipate this number to drop down significantly once that comes in. So, but we have done a great job with the delinquency. As you can see, for the last few months, it has stayed in the 2000s, in like 3,000, 2,000. This is a property where at one point the delinquency was about 30, $40,000. I'm talking about like the 60 to 90-day delinquency was that high. So we've been able to get rid of all those tenants. Now we have better quality tenants. We do have a couple that lost their jobs and they're looking for these rental assistance programs to help them bridge the gap. And we're working closely with them to monitor that as well. So we are not alarmed where we are, but we're keeping a very close eye on things and making sure that things stay that way. So as a recap of what's happening in the Baltimore market, so occupancy rate in Baltimore market increased, right? Our occupancy in like 101 Ellwood increased to like 94.5.9%, and the market was actually below market average. We're actually above the market if you look at the data on the trends. 101 Ellwood is performing better than most of the other assets in the market. Our asking rent as well has grown and continues to grow slightly. We have a dynamic pricing model which keeps track of where the market is at and make the rent adjustments as needed. Employment in Baltimore, unemployment rate reached 3.1% in October, which is below pre-pandemic levels. So now the 2,126 units that were completed, most of them are already occupied. A lot of the other units that are under construction are still far, far, far off. So Baltimore is projected to be stable, not extreme growth. But 101L would, because of where it's positioned, we think we can capitalize on the demand in this area and continue to grow slowly and give the market some time to adjust. So just as a recap, the asset is doing way, way, way better than before, than it has been for most of our business plan. We are on the other side now of our business plan where this asset is stable. But one of the most important things we've learned is you never rest on the laurels. During that period of time when things are stable, that's when we want to block the back end and continue to push on other revenue sources. And that's exactly what we're doing with the parking lot, pushing on the parking lot. We pushed on the storage. facilities as well. We've rented most of the storage spaces with some of the aggressive marketing that we did as well. So we're going to continue looking for income generating opportunities on this property and continue to increase the revenue as we go. As I said, our biggest goal, execute a successful refinance and then resume distributions on the property. So key takeaways, revenue has been consistent. NOI has increased by about 10.4%. We've reduced operating expenses and we have a plan in place to actually reduce that even more in the months ahead. And our continuous focus is on the occupancy on the property and where everything is going. So, and the occupancy on the property is improving significantly. I was just going to switch over. Before I open it up for questions, I wanted to show you guys one other thing. Let me see here. Let me pull this up. Um, so does that. Um, Give me a second here. Yeah, so this is the dashboard for let me see if I can expand this. So this is the dashboard for the platform that we use for marketing that predicts that is dynamic, that predicts how the property is performing, the occupancy and where things are. As you can see, our future occupancy, the prediction for our future occupancy by that's February 19, based on the demand that we have on the market, is 95%. Like just seeing that number from where we were with this property is like a huge sense of like of relief, and just to see how much we've been able to progress with this asset. So we're projected to be at a 95, probably 94, 95% occupancy by mid-February. And our goal is to stay with that high occupancy over time. You can see how our marketing is performing, and this is real-time data that we get. This platform, this is the marketing platform that I mentioned to you guys. Very dynamic. We keep track of the leasing as well. This is a system that we've implemented successfully across our portfolio and is doing really well. We keep track of the calls that come in on a daily basis. We listen to the calls. We're able to get recordings of the calls, listen to the calls, and see how it's doing. So we are kind of overseeing a little bit of micromanaging the managers that are on site on this property. And we've been getting a good amount of great results from that. And you can see the revenue is like B plus. So all of this is rated. We want to improve on the revenue. The marketing is great, the leasing is great, so we continue to push up to get the revenue. And so 101 Ellwood is on the right track for us to execute a successful refinance and resume distributions to all of our investors. So on that point, I'm going to open it up to questions. I see it looks like some people dropped some questions in the chat. So, and if you have any questions, you could come on mic and ask, please. So the question is about the exit period of time. So optimistically speaking, like if everything goes well, if the real estate market blows up really significantly over the next 2 years, we'll exit. The truth is, right now, the commercial real estate market in the whole, especially the multifamily real estate market, it's has experienced a significant drop. We've seen a drop in market values of about 25 to 35%. Now, we can decide to exit the property this year to meet that goal. But if we do that, no matter how much we've grown the revenue, just as a result of the market cap rate expansion, we're not going to be able to capture in that growth that we've been able to achieve. Right. So we have to give the market some time to stabilize so that we can exit. The reason why I'm saying 3 to 4 years is to be conservative, because we did promise that we were going to get in and stabilize this asset and get out in 3 years. But the market changed drastically from what we expected. So we are being very cautious on how we are projecting on how we exiting at this point in time, especially given the fact that the Baltimore market is going through its phases. So we are making a projection now based off of what we have control over. which is growing the revenue on the property and stabilizing the property. If we go to exit next year, or if we go to exit this year, we are not going to be able to capitalize and capture in the value that we've created on this asset. So we got to give the market some time to stabilize, and then we'll be able to exit. Does that answer your questions? Absolutely, Edwin. As mentioned, as soon as we execute the refinance, distributions will resume on the property. Yes, this is the only property we have in the Baltimore market. But I live in the area, so I'm always at the property. I'm always I spend at least a day every week on the at the property, keeping an eye on everything, making sure that everything is going well, and keeping an eye on the team as well. So the property looks really good. I know, Mr. Landry, you in the area. If at any point you want to visit the property, just let us know. The property is nice. It's been is being well maintained, and we're managing it properly, so we're just keeping a close eye on everything and making sure that it continues to improve. You're welcome.
And then Leslie made one very important comment that I would like to just add a little light to here. Um, the Baltimore market has struggled, and a couple of other markets in the country have struggled significantly. Um, and it's important to note that as you all are waiting for distribution, we too are trying to make sure that comes to you guys as fast as possible. And like Leslie said, look at his hair, it's going back. How his airline is going, because he's always at his asset and working and trying to implement systems, processes, marketing to be able to help increase that NOI. What we're here to do is to go in and say we want to rush and sell this deal, and we don't really capitalize on the growth that we're seeing. We've done a good job taking the property from almost 70% occupancy to 95% occupancy. So if any of you know anything about real estate, this is how exactly now you start capitalizing on that growth to actually make money on the deal. So our own money that we're supposed to get paid when we bought this deal, the way we make money on this investment, so everybody is aware, when we buy the deal and close the deal, we're supposed to get paid. We were like, no, we're going to put that money on this deal as reserve so that when we implement our business plan and you guys make money, then we're going to get paid. So we are significantly incentivized to make sure you guys get paid from this investment so that we can even make a dime from it as well. So please, if you're in the area and you want to go see the performance of the assets and how it's looking, we've actually gone in and changed some of the rug. I'm not sure if some of you went to the property at some point. Dr. Oni went on there, looked at it as like, man, we got to change this rug to attract the right set of people. We went in and changed all the rug, put in new lighting. We position the project now as a project that's attractive to the ideal tenant that we want, which are the doctors, the nurses that are going to two different John Hopkins location. Now, a lot of those people are coming to this project, and we're in prime to actually achieve that business plan that we wanted to execute on this project. So please, if we encourage you, if you're in the area, you want to check out the property. Leslie is just 25 to 30 minutes away from the project. He will meet you there, and then you can go see exactly how the asset is doing. And Ayodeji is asking, will it be useful to present the rolling 12 months data along with this 6 months?
Yeah, absolutely. And that's just what I'm showing here. This is actually the last 24 months of data of like the gross revenue. And I could put together like the 12-month data and comparison charts and send it to you, Dr. Tegbe. So but this just shows like the revenue. And as you can see, this is some of the periods where we struggled the most, like towards the end of 2023 when revenue was down, occupancy was really low, delinquency was high, and Baltimore being the market that it is, evicting tenants was really really tough. getting tenants of this property. But we were able to do that and then slowly rise up. This is it's kind of an outlier, probably due to something that got paid off later. But this is the more trend, right? This is the more reasonable trend that we're seeing. And as you can see, the income is increasing. Even now that we are 90%, we are at 220. By the time we get to 95%, our gross revenue would have increased significantly as well. So I do anticipate these numbers to continue to get better. At least that's our goal. So we continue to work on that. And we'll put together the 12-month, 6-month comparison and send it over to you, Dr. Tegbe.
And then another important thing to note about that is this: during the summer months, now we're like in January going to February. Usually it's leasing is not too good, but as you head towards the summer months, leasing activities goes up significantly because it gets warmer and people want to move. So now that we're at 95%, we are anticipating like when we get to May, June, because of this moving season, we're actually going to see a significant amount of traction for people to want to leave on this project. And the marketing effort we're doing is working. So we just keep it that way and then try to increase the revenue and reduce expenses. Now that we stabilize the assets, all the other income generating avenue that we have on the project, now we can maximize that. This is a classic asset that we can decide to say, we want to put in like a electric charging station there to see if there's a way we can generate revenue. Roof on the
So
roof, a bunch of different things that we can do because every dollar you put on this project from an income perspective, it increases the value significantly. We are in a good position to start achieving a lot of this growth on these assets for sure.
And just to re-emphasize the point about distributions, I know the reason why we all invest in these assets is so our investments can generate money for us, can make money for us, and that's our goal as well. When we get in these assets, to identify assets that make money for you as well. So sometimes during the business plan, we run through challenges that we have to pause those distributions so we stabilize the asset and get it to a good performing asset. But we are at that point right now. So our goal is to make sure that every quarter, the money that you invested in this deal is making money for you. The money that you invested in this deal is growing. It's just give it time. It's still the fundamentals remain the same. It's still a solid, nice asset in a great location in the Baltimore market. So we have stabilized the asset. We just give it time. So we're going to start giving distributions as soon as we refinance the asset so that you're making returns on your money. And if interest rates come down a little bit more and we are able to execute a cash out refinance where we refinance and we're able to pull some money out, we'll be able to catch up on most of the distributions that has been missed. Again, a missed distribution is not a lost distribution. Whatever money we make from this asset goes to you first. That we pay back the distributions that are owed to you, so that we catch up. And then as we maintain the asset, you continue to get your distributions. Absolutely, Yvonne. I'll put that together and send it over to you. The projections on the yield on investment with the extended hold. But it's the main thing that would change is the IRR because it's taking a longer period of time. But we project that we're probably gonna hit those returns or outpace the returns that we projected. But I can share that with you for sure. So, but again, our goal, as always, in any single one of these assets that we go into, is to make sure that our investors never lose their money. Number one, and number two is to make sure that our investors grow their money significantly, and number three is to make sure that we outperform the projections that we make on these assets. So, again, it's just a matter of time. Let's give it some time, and this property is going to do well. Wasn't 101 Ellwood property tax supposed to be locked because it was a bank or some historical site? That is land bank laws, actually, Edwin. The taxes on land bank laws are locked until 2033. 101 Ellwood had a tax abatement, but that expired before we took over the property. But we've been able to challenge the taxes, and we're going to be saving $100,000, and that $100,000 comes back to you, to the bottom line, comes back to you, our investors. So I really appreciate the questions, and I cannot thank you guys enough for coming and joining the call to ask these questions. Again, we want you guys to know that we are accessible to you. Um, this is your investment. This is your property, and we are accountable to you, our investors. So please, if you have any questions, reach out to us. I know this has been a challenging investment because we experienced some challenges that were worse than what we anticipated. But like one thing I can always assure you guys is we are going to work tirelessly. Going to put in whatever effort that it takes to make sure that any investment that we get into becomes a successful investment for our investors. Again, that is the only reason, that is the only purpose why we do this business. And the only way we can continue to do it is to continue to make this a successful investment for everybody. Can you share how many investors are invested in Ellwood? Mike, do you have that number?
Yeah, let me get it real quick.
Okay. Dr. Yvonne, we'll get that number for you here shortly.
Thank you.
You're welcome. So, any other questions why we get the number of investors for Dr. Yvonne? And again, if you're in the area in Baltimore, please, this is your property. You own it. Come visit it, see what you invested in, see what it looks like. I think when you come and look at the property, it's going to give you a little bit more context for why we feel strongly about the opportunity, and why we're working extremely hard to make sure that we're able to extract the full value of this opportunity as well. It's a really, really nice property that was grossly mismanaged. We've done some good work to it. We actually changed the entire carpeting on the floor, just gave it like a much, much brighter look. Updated the gym, added a package locker, upgrading the outside furnitures, doing a lot more activities on the property. A lot of tenants love it. We did rolled out like a healthcare referral program. Got a few nurses signed up for leases because of that. We got a bunch of Hopkins residents and nurses that are living on the property right now, the kind of demographic that we're looking at. And that's how we're able to see like that significant decrease in delinquency and stuff. We still face some challenges along the way with some of the tenants that we inherited, but we've been able to get rid of most of those trouble tenants, if not all. And now the property is in a very, very good position where we have to focus. We're going to be focused on increasing the income and just decreasing the expenses.
And then, meanwhile, since we have a lot of us here are investors on the call, are there some specific updates you would like to see on this asset, so that when we send out our communication about the assets, you'll be able to be informed? Leslie just mentioned a bunch of things that we've done on these assets. Some of you might not even be aware of these things, right? If you guys can put in the chat, or you send us a private email or text message or whatever, and say, Excite team, as an investor, these are some of the things that are important to me. These are, of course, distribution is number one, and then when I'm going to get my money back is another one, or get my returns back. All of those are important. If there are some other things that you like to see about the assets, please let us know, so that in our communication to you, we can include those information in there, so that you can understand exactly what's going on. Like Leslie said, our priority is to continue to work hard, but we don't want to just be working hard and then you guys don't see what's going on. If there's a better way we can communicate the activities and the things that we're doing on the projects to make you guys feel abreast of what's going on, please give us that feedback, and we will make sure we incorporate it into our communication to every one of you, so that at least as an investor, you know that you own a piece of this deal and you see what's going on. Because just like you're going to own a single family home somewhere and you're like, okay, I know exactly what's going on. We want you to be able to know exactly what's going on this asset as well, because this is an asset that you own. It's not a third party. It's you, Excite Capital. We put this risk team together to go buy these assets. So your ownership of this deal. You have ownership of this deal. So if there's any specific thing you would like to see, please don't mind. If you don't mind, please just let us know so that we can improve our communications as well.
Just a comment. Wanted to let you guys know. Appreciate you guys keeping in communication and being open to investors being able to ask questions and update. And a lot of multifamilies aren't really doing that, especially with how the market have changed. So I wanted to make a comment, at least let you guys know. Definitely is a plus and appreciated. And then the other thing I wanted to ask is when you're for the refinance, what kind of interest rates or ranges of interest rates are you guys seeing or looking at? And also, um, for cap rate right now, where's the cap rate sitting on right now for the area?
Yeah, those are great questions, Dr. Annie. The first one, the cap rates in the Baltimore, looking at like 6.5%, depending on the kind of asset. So it's more like on the 6.5, trending more on the 6.5 rate. So the interest rate, that's the biggest factor. We're getting quoted interest rates anywhere from 5.9 to like 6.2, and it's just so crazy because it changes like almost every week. Like the 10-year treasury, 1 week we're seeing it down. You're able to get like a quote of like a 5.6. And then the next week you're back to like a 6%. So but it's looking like it's just starting to trend down. So anywhere from the best case scenario we're seeing on the interest rates in the market is like 5.5. And then we're seeing it can go as high as like 6.2, 6.3 that we're seeing. Um
Thank you.
And thanks for that recognition. And the reason why we try to make sure we're doing over communicating is because we're in this together, and we want to make sure, like I mentioned earlier, you understand what's going on in your investments. We don't want this is just one of so many deals we're going to do together, and we want to make sure each of these deals that we do, you have an understanding of what you're investing in. Now, the reason why we are leading this investment is because we want to be operating it, running it, so that you can focus on what you want to do. But in as much as we want you to be 100% passive, we want to make sure you have an understanding of where your money is and what's going on with your investments. And again, if there's feedback that you have on how we can do better, please let us know. Me, Leslie, Dr. Oni, and the whole team at Excite Capital, we're 100% committed to you, the investor. We're 100% available to you so that you can engage with us and you see what we're doing. And if for any time we don't answer any questions that you have, please feel free to reach us as well.
We got a question from Mr. Landray. Was any vacancy rate factored into this whole investment? If yes, what? Yes, we always factor vacancy rate in all of our investments. The usual vacancy rate usually starts for this one. I think we're projecting at 10%, between 8 to 10% vacancy, and stabilize at a 5% vacancy. That's a 95% occupancy when it's fully stabilized. And Jade, when are we selling Ellwood? Jade, we kind of went over that in the beginning of the presentation, stating that where we are on the market right now, it's not ideal to exit out of the asset. Just because commercial real estate has experienced a significant decline in values of 25 to 30%. So if we're going to sell Ellwood right now, it's not going to put us at a good um as not going to be at a good position. So we're actually working towards executing an extension on the loan that we have through a refinance, so that it gives the market time to readjust. Most experts are anticipating it's going to take 2-3 years for the markets to fully stabilize, and then at that point we can exit. But one key important point is like we will resume distributions as soon as we execute the refinance. The asset now is stable, and we're just waiting to get that loan extended, and we will start redistributing. You start getting distributions on your investment. Uh, that's correct, Jade. We've issued out just one distributions, and every missed distribution is gonna get caught up. A missed distribution is not a lost distribution. Remember, you have a preferred rate of return, which means you're entitled to that distribution every single year. The 6% that we projected, you're entitled to that every single year. So anytime with all the distributions that have been missed will be caught up, right? Like I was explaining earlier, if we're able to execute a cash out refinance, all the cash out is going to go towards paying back all those back distributions, and then we start redistributing on a quarterly basis to you, our investors. It took us way longer than what we anticipated to get the asset fully stabilized, but we are at a stabilization point right now. It's just that the market is not ideal for us to exit at this point. Mr. Lanre, yes, 95% occupancy, we should be good. Absolutely. If we can maintain a 95% occupancy, that would be really great. And Jade, I know you joined the call a little late. I'm more than happy to schedule like a one-on-one time with you as well, and go through the presentation with you as well, to show you the numbers. And but we'll also have this recording available to you, where you can go in and review it. But thank you so much for joining, and thank you for the questions as well. And like Tenny said, everybody on the call, please do not wait until this calls to ask us questions. We are accessible to you. Like we are partners with you on this asset. We will keep working hard every single day to get the asset, make it a successful investment for us all, because we are also investors in this asset. But if you have any questions, please reach out to us any period of time and ask questions. Ask us the hard questions. Challenge us on anything that we say. The only thing we can do from being challenged is to learn and get better, and that's what we aim to do every single time. So again, we do not take for granted the trust that you have in us. We do not take for granted your investment. We know how hard it is for you to work to generate the capital that it takes for you to invest in these assets, and we select these assets fully knowing that there's a very, very low chance of you ever losing your capital in investing in these assets. But some of these things just take time, and that's one of the things that we're learning in this market, the way things are changing. Time, but we focus on what we have control over, which is stabilizing the asset, and getting you back to receiving distributions on the asset. Any other questions? You're welcome, Dr. Annie. Thank you so much for joining. I appreciate you. And we're going to be doing this every quarter. We're going to have another presentation on Ellwood in April. And I hope to come with the graph looking in this direction, and with continued great news. So please, don't hesitate to reach out if you have any questions. Thank you, everybody. Have a wonderful night.
Thank you, everybody.